You're not so bullish, and I have some. With that in mind, I'm just wondering what we should do. So you have a bias away from U.S. equities, cautious on risk assets, and you're actually thinking about fixed income, but as you point out, maybe investment grade. So you're looking at just a difficult economic period. When you decide to go into corporates, you got in the back of your mind, you got to think about what you're saying about equities, because it could affect. You better go with quality, because there could be some companies that don't do so well if the entire economy is not doing so well.
We are cautious on the U.S. equity market, Joe, and really, if you look across the board, the indicators are sobering right now. So macroeconomically, if you look at an array of different indicators, what you see is growth is still in positive mode, but it is decelerating. And that's really echoed as well what we see in terms of the corporate front, because when we look at earnings and sales, again, they've managed to hang on to some decent absolute levels. But again, overall, what you see are slowing in the numbers, and estimates are coming down. Our biggest concern really at this time, though, is really what's going on the monetary policy front. And with the Fed so resolute about continuing to combat inflation and to bring up those interest rates as well as quantitative tightening, that just makes for a difficult environment for stocks.
And what they're dealing with is inflation, and you're worried. Inflation hits a couple of ways. It hits consumers, so that's not good, and then it hits margins, profitability for these corporations that you're talking about. A lot of these things are already front and center, Lisa. You expect, are we not negative enough about how long it lasts or how bad it gets?
We have had a tough year, obviously, here in the U.S. equity market, and so valuations we think are in the zone of okay. Really, though, as we look forward, the question really becomes, is there potentially another drop? And we are concerned that while multiples have come down and prices have come down, if those growth estimates and those earnings estimates come down even further, that could spell additional trouble for the U.S. stock market.
We have strong jobs numbers, and we've had those back-to-back quarters. I think, in your view, we're not in a recession right now. Is that correct?
We don't necessarily see the signs of recession immediately. It certainly could be on the horizon. So that is something we'll want to watch. But to your point, so far, most of the indicators are still in growth, positive, slight territory.
So, but you would only give it a probability, maybe a 50, I don't know, whatever it is, 50-50, 70-30 about whether we do see a recession. It does matter when you're trying to decide what to do with your money, obviously. So what about fixed income? If you have a bias away from U.S. equities, I can't imagine that you'd go into European equities. So if it's a bias away from the U.S. equities, is it into fixed income, or are you talking about somewhere else in the world where you'd buy stocks?
We are seeing fixed income and as to your point earlier, investment grade as particularly interesting right now. And while a difficult Fed environment with them tightening also can impact fixed income, the higher cash flows of fixed income and their historically lower volatility really can provide a nice ballast in a more difficult economic environment.
So you're talking domestic investment grade corporates. How long?
We really foresee for the foreseeable future, again, really more of a cautious stance rather than a risk-on stance. And so, again, moving towards more of those ballast types of assets like U.S. bonds really, in our view, makes sense at the current time.